a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
ETFs versus ETNs. There is a difference, and we're going to find out what that difference is now with our ETF Research Director, Nina Mishra, who joins me. This ETNs have been in the news lately. You've been quoted in some stories on different news outlets about this very topic, but they've been in the news because of something that may be not so good.
Yeah, unfortunately for negative reasons, they have been in news. Last week, Credit Suisse delisted two of its ultra-popular exchange-traded notes, ticker UWTI and DWTI. And that surprised or shocked investors because usually sponsors liquidate a fund only if there is not enough investor interest. But in this case, these two funds had almost 1.9 billion in assets under management, and that's why it shocked investors. So I thought this would be a good time to understand the differences and risks associated with exchange-traded notes.
Sure, because investors confuse the two probably routinely, probably
Yes.
more than we know.
Yeah.
All right, so let's start at the beginning then. What are these ETNs or exchange-traded notes?
So exchange-traded notes or ETNs are basically unsecured debt instruments issued by a major bank or a financial institution. And unlike ETFs actually hold the securities which comprise the index that they track. ETNs do not hold any security. Only the issuer, ETN issuer, promises to pay investors the amount which is reflected by index's performance minus the fees charged by them.
All right, and I'm sensing here, just by the tone of your voice, that there are some risks associated with ETNs.
Yes. Because as I mentioned that they are unsecured debt, so first there is credit risk of the issuer.
Okay.
So if the issuer goes bankrupt, there is a chance that investors may not receive their full proceeds back, and that actually happened when Lehman went bankrupt in 2008. Some investors lost some money. So there is credit risk. And then maturity date, because these are, again, debt instruments, so they have a maturity date, which is typically 30 years from the date of issuance. But some of these notes have a call feature as well, so they can be redeemed before the
maturity date.
Yes.
Sure, just like a bond.
Yeah, exactly. And then there is price tracking risk also. Normally ETNs trade at fair prices, which is when their market prices are close to their intrinsic values or NAVs. But there are many instances when they trade at substantial premium or discount compared to their NAVs. And that actually happened earlier this year in case of a popular oil note with the ticker OIL, oil. For quite some time, it was trading at almost 50% premium to its net asset value. And in fact, Barclays, the issuer, issued a warning about investors about buying the note when it is trading at a significant premium to NAV. Because if you buy when the note is trading at a premium to NAV and the premium crashes later, then you incur unexpected losses. So that can happen. And then sponsors can liquidate the note before maturity, and if that happens, if they liquidate or delist an ETN, then the liquidity associated with that note is just going to vanish, and investors are going to find it very difficult to trade that ETN.
And on the flip side then, I'm gathering ETFs don't have these risks.
ETFs actually hold those securities, so they normally do not have any of these risks that we mentioned.
Okay. Providers decide to liquidate notes for a lot of various reasons, right? So I guess it's buyer beware with these ETNs?
Yes, yeah, obviously they have to be aware of all the risks associated with ETNs. They can be recalled early, they can be delisted, so they could be price tracking error due to these issues. So when you buy an ETNs, you have to be prepared for those kind of risks.
Okay, and the benefits, though, of ETFs are, it's a short list.
It's a short list.
Right.
So because they do not hold any securities and they match the performance of an index, there is no tracking error. In case of ETFs, because they hold securities, and sometimes if the index comprises of too many securities, like 2,000 securities, then the ETF will not hold all securities. They will just select some securities, say 500 securities, by a process called sampling. So that leads to tracking error, the difference in the performance of the index and the difference in performance of the fund. But in case of ETNs, there is no tracking error. And the second advantage is that the ETN structure is quite tax friendly in certain asset classes, particularly commodities and MLPs. So in fact, MLP is the only asset class where I recommend purchasing ETNs over ETFs because of their tax efficiency.
Okay, and I misspoke a moment ago. I said benefits associated with ETFs. It should have been benefits associated with ETNs.
Yes.
A short list. Okay. Well, we thank you for that little bit of education. Don't forget, you can get more information on ETFs in the ETF section of Zacks.com. And all you need to do to get there is go right to the homepage, use the Funds tab in the top toolbar. That creates another drop-down window that has an ETF in that window. Click on it, takes you right to it. With Nina Mishra, I'm Terry Ruffalo.